Hey everyone, and welcome to the show. Did you just get an email from your HR department about open enrollment? Or maybe you're navigating the marketplace on your own, trying to figure out what plan is right for you? Whether it's open enrollment season or you've had a big life change like a new job, a new baby, getting married, the world of health insurance can feel like a foreign language. The decisions you make now don't just affect your health care for the next year. They can have a huge impact on your long-term financial health. That's why today we're going to demystify it all. We'll walk through the most important terms you need to know, from your premiums and deductibles to co-pays and co-insurance. Then we'll talk about how these choices connect directly to your wallet. We'll give you some clear, actionable tips to help you choose the best plan for you and your family. Let's dive in. Welcome to Financial Coaching Kingdom, the podcast that helps you align your money with your purpose. I'm your host, Jon. We've all felt the weight of financial stress, the sleepless nights, the silent disagreements with our spouse, the feeling that we've just not in control. But what if there's a better way? What if managing your money was less about math and more about peace of mind? On this podcast, we'll explore a different kind of financial freedom. It's not just about what you earn or what you owe. It's about the emotional clarity that comes from being on the same page with your spouse, the spiritual strength you gain from worshiping God with your finances, and the deep satisfaction of knowing you're building a lasting legacy for your family. Every week, we'll cut through the noise to bring you simple, powerful truths that will help you move from financial chaos to confidence. If you're ready to find clarity, grow in unity, and live with purpose, you're in the right place. Let's get started. Did you get a notification from your HR department that open enrollment time is here? Or are you insuring yourself and you heard that open enrollment period for healthcare.gov insurance plans are from November 1st to January the 15th? Or maybe you had a life event like getting married, having a baby or adopting, loss of employment or getting a new job? If so, the information you're going to receive is a lot and many people find it confusing. The decisions you make now can affect your health insurance coverage for the next year and can affect your finances for years to come. We're going to walk through some of the common terminology that you should be familiar with as you sign up for your health insurance, discuss how these decisions can affect you financially, and offer some ideas to consider when deciding which is the best plan for you and your family. Before you can make a confident decision, it helps to speak the same language as your insurance provider. Let's break down some important terms you'll see. Premium. Think of this as your monthly membership. It's the amount you pay every month just to have insurance coverage, whether you use it or not. The premium is what you'll see deducted from your paycheck or pay directly each month. Deductible. This is the amount you have to pay for covered medical expenses before your insurance company starts to pay. For example, if your deductible is $2,000, you are responsible for the first $2,000 in medical bills each year. Once you have paid them that much, your insurance will start to kick in. Copay, co-payments. A copay is a fixed amount you pay for a specific service after your deductible has been met. For example, you might have a $25 copay for a doctor's visit or a $50 copay for a specialist. Co-insurance. This is your share of cost of covered services and is expressed as a percentage. For example, a plan with an 80-20 co-insurance means your insurance will pay 80% of the cost for the service and you'll pay the remaining 20% after you've met your deductible. Out-of-pocket maximum. This is your financial safety net. It is the absolute most you will have to pay for covered medical expenses in 1 year. Once you hit this amount, your insurance will pay for 100% of all other covered services for the rest of the year. This is a crucial number to know because it sets the upper limit for your financial risk. Now that you know the terms, let's look at how they connect to your personal finances. When choosing a plan, you are essentially making a trade-off between your monthly premium and what you'll pay when you actually use healthcare services. The high premium, lower deductible. This type of plan is generally a good fit for families who anticipate frequent doctor visits, have a chronic condition, or expect a medical procedure in the coming year. You pay more each month, but your out-of-pocket costs for each visit are as much lower. This predictable cost can be a great relief if you know you're going to use your insurance often. Or the low premium, high deductible. This option is often best for healthy individuals or families who don't expect to need much medical care. Your monthly cost is low, which can save you a lot of money throughout the year if you stay healthy. However, if a medical emergency or a major health issue does happen, you'll be responsible for a large bill before the insurance coverage fully kicks in. This is why having an emergency fund is so important. The best plan for you and your family is a personal choice based on your health history, expected needs, and financial situation. It's not just about finding the lowest monthly payment. It's about finding the best value. As you review your options, here are some practical tips to help you make an informed decision. Assess your need. Look back at your past year. How many times did you go to the doctor? How many prescriptions do you fill? Think about any planned surgeries or health events for the upcoming year. Your history is a powerful predictor of your future needs. Check your network. Make sure your current doctors, specialists, and hospitals are in network for your plans that you're considering. Using an out-of-network provider can result in significantly higher cost or no coverage at all. Consider the worst-case scenario. Ask yourself, if a major health event occurred, could we afford to pay the deductible, the co-insurance, up to the out-of-pocket maximum? This number is your true financial risk. Choosing a plan with a manageable out-of-pocket maximum can give you peace of mind. And don't forget about the HSA. If you're considering a high deductible plan, look for one that is compatible with a health savings account, an HSA. An HSA allows you to save money tax-free to cover qualified medical expenses. This can be a powerful tool for managing high deductible and saving for the future medical cost. Read through the enrollment packet and don't shy away from asking your HR representative questions. Choosing a health insurance plan can be confusing, but by understanding a few key terms and thinking about your family's unique needs, you can make a smart decision. You've got this. This journey isn't just about you. It's about building a legacy for your family. If you're married or in a relationship, share this episode with your partner. Have a conversation about the principles we've discussed and start building a financial plan together. A strong team starts with a shared vision. If you're considering the high deductible health insurance plan, HDHP, during open enrollment, you may have the option to open a health savings account, HSA. This is a powerful tool that transforms the way you manage your healthcare costs and saves for the future. A HSA is essentially a personal savings account, but it has incredible tax advantages. It offers a triple tax benefit that no other savings vehicle provides. Contributions are tax deductible, lowering your taxable income for this year. The money grows tax-free, just like in a retirement account. Withdrawals are tax-free when used for qualifying medical expenses. This means you get a tax break on the money going in, tax break on the money while it grows, and no taxes when you take it out for medical needs. Unlike flexible spending accounts, FSA, Your HSA funds belong to you and roll over from year to year. There's no use it or lose it pressure, making it a fantastic tool for both your current healthcare needs and long-term retirement savings. The list of qualifying medical expenses is extensive, giving you a lot of flexibility. In short, if it's a medical care, diagnosis, cure, or treatment, it's likely to qualify as a medical expenses. HSA Bank offers a list of eligible and ineligible items in their eligibility list. Check them out. Here are some common examples of items you can pay for with the HSA funds. Doctor and hospital visits. This includes copays, deductibles, coinsurance for appointments, specialist care, lab work, and hospital stays. Prescriptions. The full cost of prescription medications and insulin. Dental care. Cleanings, fillings, braces, and other dental treatments. Vision care. Eye exams, eyeglasses, contact lenses, and even laser eye surgery. Preventative care. Flu shots, wellness exams, and other preventative services. Medical equipment, crutches, bandages, blood pressure monitors, and more. Over-the-counter medications. Many over-the-counter medications are now eligible, as well as period products. Check out the publication 969 from irs.gov on the IRS website to confirm what is qualified this year. As HSA provides a way to pay for these necessary expenses with tax-free dollars, giving you more control over your health care and your money. It's a strategic move that can save you thousands of dollars over time, all while building a nest egg for future health needs. Understanding when and how to add or remove money from your HSA is crucial for maximizing its benefits. You can contribute to your HSA at any point during the year. The deadline for contributions for a given tax year is the tax filing deadline for the following year, which is typically April the 15th. This gives you extra time to fund your account and still get tax deductions for the previous year. The IRS sets limits on how much you can contribute, and these amounts are based on your health plan coverage. The limits apply to the total amount contributed from all sources, including you, your employer, and anyone else who contributes on your behalf. For 2025, individual limit was $4,300. For family limit was $8,550. Check what it is for this year. If you are 55 or older, you can contribute an additional $1,000 as a catch-up contribution. You can take money out of your HSA at any time. The key is how the money is used. For qualified medical expenses, all withdrawals used for qualified medical expenses are tax-free, penalty-free, regardless of your age. For non-medical expenses, if you withdraw funds for a non-medical reason before the age of 65, the money will be subject to your normal income tax rate plus a 20% penalty. This is why it is so important to save your HSA funds for medical costs. Once you reach age 65, you can withdraw money from any reason without the 20% penalty. However, you will still have to pay income tax on the withdrawal if it is not used for qualified medical expenses. This flexibility is what makes an HSA such a great long-term savings tool. It's essentially a retirement account with an added bonus for healthcare costs. Are you using an HSA to save for the future? We'd love to hear your experiences or any tips that you may have for others in the comments.